Well, folks often ask me about the secrets to investing, about how we built Berkshire Hathaway into what it is today. They look at the balance sheet and the market cap, and they think there must be some special sauce, some complicated formula. The truth is, it's mostly about avoiding bonehead mistakes and having the patience of a saint. And believe me, I've made my share of bonehead mistakes. One of my biggest, and certainly one of the costliest in terms of opportunity, was buying into the original Berkshire Hathaway textile operation back in I had been buying shares since 1960, picking them up for under eight. It was a textile company, a dying industry in New England, and I knew it. The capital was tied up in plants and machinery that were fighting a losing battle against cheaper foreign competition. But I got greedy, or rather, I got stubborn. There was a tender offer from the company, and I bought more stock, expecting them to buy me out at a higher price, perhaps 11. The chairman, Seabury Stanton, instead offered 11. I felt like I'd been sandbagged. I told myself, Warren, you're not going to let this guy push you around. What a fool I was. Instead of taking the 11.3075 and putting my capital into a business with better prospects, I bought more shares, took control, and fired Mr. Stanton. My motivation was entirely emotional. It wasn't about the business prospects. It was about getting even for that slight difference in price. It was a purely emotional decision, a prideful one, and it cost me dearly. We poured good money after bad for years, trying to modernize the mills, trying to make a silk purse out of a sow's ear. But you just can't fix a fundamentally broken business that way. We eventually shut down the textile operations in 1985 after 23 years of frustration. That initial capital, plus all the subsequent capital we sunk into it, could have been invested in a truly wonderful business, a business with strong competitive advantages, what Charlie and I call a moat. If I had just taken that money and put it into, say, the insurance business back then, the compounding over those decades would have been astronomical. Charlie always tells me, Warren, if you find yourself in a hole, the first thing to do is stop digging. That textile mill was a deep, deep hole. I've estimated that mistake probably cost Berkshire about $200 billion in lost opportunities over the years. What a bonehead move motivated by pride and $0.25. Here's what I learned from that mistake, and it's a lesson that Ben Graham first etched into my mind back at Columbia. Always focus on the intrinsic value of a business and buy it with a significant margin of safety. But beyond that, you've got to understand the fundamental economics of the business you're getting into. Is it a business that creates value for shareholders over time, or one that constantly consumes capital just to stay afloat? The textile business was the latter. It was a commodity business with no pricing power, intense competition, and high capital requirements. It was a treadmill. Investing is like playing baseball. You don't have to swing at every pitch. You can stand there and wait for the fat pitch to come right over the plate. The problem is most people feel compelled to swing. They see action all around them, and they feel like they're missing out. But in investing, unlike baseball, there are no called strikes. You can wait as long as you need for that perfect pitch. The textile business was a curveball in the dirt, and I swung anyway out of stubbornness. Ben Graham taught me that price is what you pay, value is what you get. With Berkshire, I paid a low price for a company that was structurally worth less than its assets because it was in a terrible industry. It was a classic cigar butt investment, a final puff of value left. Graham taught me to look for these, but even he would agree that buying into a truly dying business is a dangerous game. It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. I was buying a fair company in a terrible industry at a wonderful price, and that's still a recipe for mediocre returns or worse. Now, you don't need to be a genius to understand this. You don't need fancy math or Harvard MBA. You just need a clear head and a bit of common sense. Think about a lemonade stand. If you're constantly buying lemons and sugar, selling lemonade, and the profit margin is so thin that you can barely cover your costs, and new lemonade stands keep popping up across the street, that's a bad business. You'll work hard, but you won't get rich. Now, if you're the only lemonade stand in town with a secret recipe that everyone loves and people are willing to walk an extra mile and pay a bit more for your lemonade. That's a good business. That's what we look for at Berkshire. This reminded me of when Charlie and I looked at See's Candies back in 1972. It was a business that required little capital, had a fantastic brand, and produced great returns on tangible assets. It sold for $25 million. The owners wanted $30 million. We felt the value was $25 million. Charlie said, Warren, sometimes you just have to pay up a little for quality. We paid the $25 million, and Cease has since generated over $2 billion in pre-tax earnings for Berkshire. It needed very little capital reinvestment, which meant we could take the cash out and deploy it elsewhere. Compare that to the textile mills, which were constantly begging for more capital. When we bought Coca-Cola in 1988, we invested $1.2 billion. It was a company that was already well-known, loved globally, and had an incredible brand moat. People questioned why we would buy such a mature business, but the fundamentals were clear. A simple, understandable product, a global distribution network, and a brand that resonated deeply with consumers. That investment has grown to be worth many, many multiples of our original cost, and it still pays us hundreds of millions in dividends. We didn't need to reinvent the wheel. We just needed to identify a great business and let it compound. Another lesson, in a different vein, came from American Express in 1964. They had a huge problem with the salad oil scandal, where a company they had lent money to, Allied Crude Vegetable Oil Refining Corporation, turned out to be a fraud. American Express, through its warehouse receipts, was potentially on the hook for hundreds of millions. The stock plummeted from $60 to $35 in a few weeks, while everyone else was panicking and dumping their shares. I was spending a week in their offices, talking to employees, even going to their warehouses. I wanted to understand if the operational business, the traveler's checks, the charge cards, was still sound and trusted. I saw the lines of people still buying traveler's checks, still using their cards. I realized the underlying business was incredibly strong and people still trusted the brand. So I invested a big chunk of my partnership's money, about 40% of our capital, $13 million at the time, into American Express stock. Many thought I was crazy, but it wasn't a gamble. It was a calculated risk based on a deep understanding of the fundamental business and its reputation. The market was serving me a bargain because of fear, not because the core value of the business had eroded. The stock quickly recovered, and we made a bundle. It was a great example of being greedy when others are fearful, but only after doing your homework. If you're a young investor today, the single most important thing I can tell you is to develop your own circle of competence and stick within it. Don't try to be an expert in everything. Understand what you know and what you don't know. I often get asked why I don't invest in certain tech companies. The answer is simple. I don't understand how they create enduring competitive advantages or how their business models will evolve in 5 or 10 years. If I can't understand it, I don't invest in it. It's that simple. What I'd tell my younger self and what I tell every investor is that you don't need to do extraordinary things to get extraordinary results. You need to do ordinary things extraordinarily well over a very long period of time. That means buying good businesses at sensible prices and then doing nothing. Sit on your hands, watch the value compound. Most people are too busy trying to trade in and out or chase the latest hot stock. That's a fool's errand. People think you need complex algorithms, daily stock charts, or inside information to succeed, but actually you just need patience, discipline, and a fundamental understanding of how businesses make money. Imagine the market showing up at your door every day, offering to buy your shares or sell you his at a different price. Sometimes he's ecstatic and offers a high price. Other times he's depressed and offers a low price. Your job isn't to listen to Mr. Market's mood swings. Your job is to decide if his offered price makes sense in relation to the intrinsic value of your business. If it doesn't, just ignore him. He'll be back tomorrow. This applies to any business, not just investing in publicly traded companies. What really matters in business is finding an enduring competitive advantage, what Ben Graham called a moat. This could be a powerful brand, a unique technology, a cost advantage, or network effects. We want businesses with wide moats that are growing wider. We found this in companies like Geico with its low-cost direct-to-consumer insurance model, or See's Candies with its beloved brand and loyal customer base. These are businesses that don't just survive, they thrive year after year, generating cash without demanding endless capital. Beyond the moat, the quality of management is paramount. I'd rather have a wonderful business at a fair price with outstanding managers than a fair business at a wonderful price with mediocre managers. Good managers, people like Ajit Jain at our insurance operations, are worth their weight in gold. They are rational, honest, and focused on building long-term value for shareholders. They treat shareholder money as if it were their own. Human nature plays a huge role in all of this. The herd mentality is a powerful force. People see others getting rich quickly in some speculative frenzy, and they feel they have to join in. That's when mistakes happen. The greatest fortunes are not built by following the crowd, but by thinking independently, being patient, and capitalizing on the crowd's irrationality. As I always say, be fearful when others are greedy, and greedy when others are fearful. But that's not the only lesson I learned the hard way about managing businesses and capital. Sometimes, even when you have a general understanding of an industry, you can still get burned by the specifics. This reminds me of another time when I was a bit too clever for my own good, or perhaps just too stubborn to admit I was wrong. The next mistake cost me a fair bit of capital and a lot of pride, teaching me another valuable lesson about capital allocation. I remember my initial foray into the airline industry. My first big mistake was buying into US Air in 1989. Now, I should have known better. Charlie always tells me, Warren, stick to what you know. Airlines are a terrible business, and he was right. Airlines were the very definition of a commodity business. Huge capital expenditures for planes, high fixed costs, powerful labor unions, and fierce price competition. Every time fuel prices went up, their profitability was squeezed. Every time there was a recession, people stopped flying. It was a business that consumed capital and frequently went bankrupt. But I saw an opportunity in their preferred stock, which offered high dividend yield. I bought $258 million worth of US Air preferred stock. The dividend looked attractive on paper, but the underlying business was a mess. The company teetered on the brink of bankruptcy multiple times. I vividly remember losing sleep over that investment. Every time I heard news about rising fuel costs or potential airline strike, my stomach would clench. It was a constant source of worry. Eventually, we got out of it, thankfully, without a major loss. But the stress and the time spent managing that problematic investment were huge opportunity costs. What I learned from US Air, a lesson reinforced many times since, is that even a cheap security in a fundamentally bad industry is still a bad investment. The promise of a high dividend or a low PE ratio means nothing if the underlying business is structurally challenged. There's no amount of financial engineering that can overcome poor business economics. The most important thing in a stock is the business it represents. And if that business has no durable competitive advantage, if it's constantly fighting a losing battle, then you're probably better off staying away, no matter how appealing the price seems. Ben Graham's concept of a margin of safety is paramount, but it applies to the business as much as to the price. The margin of safety in the business model itself. Is it resilient? Can it withstand downturns? Can it maintain pricing power? Airlines for the longest time just couldn't do that. They were a capital guzzler with razor thin margins. My dad, who ran a stock brokerage during the Depression, taught me about looking at the soundness of a business, not just the stock ticker. The airline industry consistently failed that test. Charlie and I were sitting in the office one day years later when the idea of investing in airlines came up again. I said something like, well, Charlie, perhaps the industry has changed. Maybe they're more disciplined now. He just looked at me with that dry wit of his and said, Warren, if you're going to put a lot of money into airlines, you should just buy a mirror and shave every morning because you're going to be looking at the same fool you looked at before. He was right, of course. For decades, it felt like a trap. Though I will admit, we did dip our toes back into the major airlines much later, a decision I then largely reversed. Even a broken clock is right twice a day, but that doesn't make it a good timepiece. This brings me to another key principle. Always invest within your circle of competence. For decades, I completely avoided airlines because I knew them to be problematic. My mistake with US Air was straying just outside that circle, seduced by a seemingly attractive preferred stock. It's far better to own a piece of something you deeply understand, even if it's less exciting to the market, than to chase after something you don't. Take Geico, for example. We started buying pieces of Geico back in 1951, before I even ran my partnership. I visited their office on a Saturday, met Lorimer Davidson, and he explained the direct-to-consumer insurance model. It was so simple, so logical. They could underprice the competition because they cut out the agent commissions. It was a business I understood, a business with a clear competitive advantage. Today, it's one of the cornerstones of Berkshire, generating billions in underwriting profits and float every year. That's a good business, simple and understandable, with a wide defensible moat. Our position in Apple, which came much later in 2016, might seem like I've finally strayed into tech, but it's actually well within my circle. We didn't buy Apple because it's a tech company. We bought it because it's a consumer products company with an incredible brand and ecosystem. People love their iPhones. They stand in line for them. They're an integral part of their lives. That's brand loyalty, and that's a powerful moat. Charlie and I looked at it not as a gadget maker, but as a business with an enormous sticky customer base. It reminded us of Coca-Cola, but with a different kind of daily engagement. It was a business I could understand and one that required little capital to maintain its dominance. So if you're a young investor today, what's the practical wisdom? First, read. I spend 80% of my day reading annual reports, 10Ks, newspapers, biographies. That's how you build knowledge. You want to understand every facet of a business, from its competitive landscape to its management team. Read, read, read. And not just things that confirm your existing beliefs. Read broadly. Second, simplify. Investing is really quite simple. It's not about complexity. Most people try to make it harder than it needs to be. You don't need fancy math or sophisticated models. You need to understand the fundamentals. What does the business do? How does it make money? Does it have a sustainable advantage? And is the price reasonable for what you're getting? If you can't explain it simply, you probably don't understand it well enough to invest in it. Third, think long term. Our favorite holding period is forever. Compound interest is truly the eighth wonder of the world. If you start early and let your money compound, even small amounts can grow into fortunes over decades. But you have to resist the urge to tinker, to trade, to panic. The market is there to serve you, not instruct you. It will offer you opportunities to buy low and sell high, but only if you have the patience to wait and the discipline to act when the time is right and remain inactive when it is not. This also connects to broader business principles that extend beyond just investing in stocks. What really matters in business is building something durable, something that will last. That means focusing on your customers, providing real value, and treating your employees well. At Berkshire, we've always looked for companies with strong cultures, led by honest and capable people who genuinely love their businesses. We give our managers incredible autonomy because we trust them. That trust is paramount.
Look at what we learned from See's Candies. We kept their local management, their culture, their product, and just let them do what they did best. That approach has worked across many of our subsidiaries. We don't bring in synergies or restructuring consultants. We buy good businesses and let good people run them. That takes patience, and it means sometimes leaving things alone when others would be tempted to meddle. That's how you build lasting value in any enterprise.
We also look for businesses that don't rely on constant debt. Rule number one, never lose money. Rule number two, never forget rule number one. And debt, especially excessive debt, is one of the quickest ways to lose money or at least put yourself in a precarious position. I've never borrowed significant money personally, and we run Berkshire very conservatively with a fortress-like balance sheet. When the inevitable bad times come, you want to be in a position of strength and not desperation. But that doesn't mean we haven't been tempted or that I haven't made other kinds of mistakes related to management. Sometimes the problem isn't the industry or even the business itself, but the people running it. This reminds me of the time I trusted the wrong kind of management, seduced by their promises and their apparent genius. It was a costly lesson about due diligence and about recognizing when even good people can make bad decisions. I remember my investment in Dexter Shoes in the mid-90s. It was a company based in Maine that made good shoes, and it was a solid business at the time. I bought it using Berkshire stock, thinking I was getting a great deal. It turned out to be one of my worst deals. I paid $33 million in Berkshire stock, which back then was worth a certain amount, but that stock has compounded massively since. So in hindsight, the true cost of Dexter was enormous. The mistake wasn't just the industry, which eventually succumbed to cheaper imports like textiles did. My real blunder was failing to recognize that the company's competitive advantage was far more fragile than I believe. It wasn't just the factory or the brand, it was also the distribution and the relationship with retailers. When the landscape changed, the moat evaporated quickly. I also misjudged the ability of management to adapt to a rapidly changing global market. When the business started to struggle, instead of recognizing the fundamental shift, I clung to the idea that we could turn it around. It became a pride issue again, much like Berkshire's textiles. I was too slow to cut my losses and redeploy that capital. The managers were good people, but they were trying to fight a tide they couldn't overcome. Eventually, the value of the business and our investment dwindled to nothing. It was an expensive reminder that even good people can't save a business if its fundamental economics are being eroded. What I learned from Dexter was that you need to be honest with yourself when a business is fundamentally impaired, whether it's by industry changes or management missteps. Don't fall in love with a stock or a business or even a manager. Your loyalty should be to the fundamental value creation. If the value isn't there or is disappearing, then it's time to move on, no matter how much you initially paid or how much you admire the people involved. It's not about IQ. I've seen people with a 60 IQs fail because they lacked emotional control and couldn't admit when they were wrong. This is where Charlie Munger's influence has been invaluable to me over the decades. Charlie always challenged my thinking, pushing me to look for higher quality businesses with enduring competitive advantages, even if they seemed a bit more expensive initially. He pounded into my head the idea of thinking about opportunity cost. What else could that capital be doing if it wasn't tied up in a struggling business? His framework helped me move beyond merely cheap assets to truly wonderful business. My dad taught me the value of integrity and hard work, and Ben Graham gave me the intellectual framework for valuing businesses. But Charlie, he sharpened my focus on quality and competitive moats. He changed my thinking from buying cigar butts to buying wonderful businesses at fair prices. That shift, more than anything else, has been responsible for the vast majority of Berkshire's success. It's hard to overstate his impact. We've been partners for so long, arguing and laughing and playing bridge, and he's truly been the best partner a guy could ask for. Over at Berkshire, we've always operated with a simple philosophy: find businesses we understand with enduring competitive advantages, run by honest and capable managers, and buy them at a sensible price. then hold them. Sometimes we get lucky, like when we bought See's Candies and its price just kept compounding. Other times we make mistakes, like Dexter's shoes, and we have to learn from them. The key is to keep learning, keep adapting, but always stick to those core principles. Our annual shareholder meetings in Omaha are a testament to this philosophy. We've had 40,000 people show up year after year, not for fancy presentations or complex financial models, but to hear about simple, understandable business principles. I write the annual letter myself, and I try to explain things in a way that anyone can understand, because the truth is the fundamentals of good investing aren't complicated. They just require discipline and patience. I still live in the house I bought in Omaha in 1958 for $31,500. I drive myself to the office every day. My diet might consist of cherry Coke, See's Peanut Brittle, and Dairy Queen. But the principles of how I run my life and my business are rooted in simplicity and common sense. You don't need a lavish lifestyle to be successful, and you certainly don't need one to invest wisely. In fact, often the simpler the approach, the better the results. After 80 years of doing this, here's what I know for certain. The market is a marvelous mechanism for transferring wealth from the impatient to the patient. It's a game where you don't have to be brilliant. You just have to be rational and patient when others are emotional and irrational. Avoid debt, live within your means, and let compound interest do its magic. I'm 94 now, and if I could tell young investors one thing, it would be this: start early, learn continuously, and cultivate a temperament that allows you to be calm when others are panicking and discerning when others are exuberant. Don't get caught up in the daily noise. Focus on owning pieces of wonderful businesses, not on trading stocks. Understand what you own, and never invest in a business you can't understand. I'd never bet against America. The ingenuity, the resilience, the free market system. It's an incredible engine of progress. While there will always be bumps in the road, over the long term, investing in America has been, and I believe will continue to be, a winning proposition. Just pick your spots carefully and let time be your friend. You don't need to be brilliant. You don't need inside information, and you don't need to do extraordinary things to get extraordinary results. Just stick to the basics, understand what you own, and act with patience and discipline. As Ben Graham always stressed, having a margin of safety in your purchases and understanding Mr. Market's mood swings will serve you well every single time. It's really quite simple, folks. It truly is.